Welcome to Colonie TV, the governmental educational channel for the town of Colonie. Hello and welcome to The Money Factor. I'm Richard Naylor, your host. Our guest today is Patricia Stackpole. She's with H&R Block and they're located at Shoppers Park on Wolf Road. We're going to be talking about what's new for 2013, and we're also going to go into a few other common questions that they often get in the shop. So I want to really welcome you, Patricia, and
well, thank you, Richard. Thank you for having me.
Well, it's great to have somebody who knows something about this to ask questions.
At tax time.
Especially at tax time.
Right.
Give a little background first on yourself.
Okay.
How long have you been doing this?
I don't even keep track anymore. It's so long, between 25 and 30 years.
Wow, okay.
Okay, and I started working for H&R Block as a part-time job and thought this was a good thing to do while my children were young, and just stayed on. And people ask me sometimes if I'm going to retire, and I say I have the perfect retirement job. I don't want to retire.
Just thinking and helping.
Right. Yeah. I'm an enrolled agent, which means that I've passed a test administered by Internal Revenue Service to demonstrate competency in certain areas of tax preparation. And people who are enrolled agents are able to go and argue cases in court for taxpayers. I will tell you quite honestly, I would not do that for a client, even though I would be allowed to, for fear that because I do not have a legal background, that I'd leave out some legal filing requirement and jeopardize my client's case by doing something that I wasn't aware of because I didn't have the legal background.
Right, so the technicalities of all the legal loopholes and
well,
details.
I'm thinking more about filing motions and counter motions and things like that. I mean, I'd be comfortable talking about the taxes.
Right.
But
you're an expert witness, but
right. But I can fill out a form for IRS. Not sure I could fill out the right form for the court.
For the judge, right.
Right. So that's a bit about my background.
So let's go into what's new for 2013.
What's new for 13? There are some things that are new because they stayed in effect and people thought they were going to go away.
That's important.
Okay, and I won't talk too much about them because they're really just a continuation of what we had last year. I guess the new things really are the broadening of the brackets. Every year for inflation, all the tax brackets, the standard deduction, personal exemption are adjusted. Most of the newness, though, that's the newness that we're accustomed to, most of the newness is for higher income taxpayers. And two numbers you need to know when we talk about higher income is $200,000 income, adjusted gross income if you're single, $250 if you're married filing jointly, and then $400 and $450. Those are sort of break points. And there are other numbers which I don't bother to memorize because I have a computer that keeps track of this for me. But if you are there and your income is over that $250, you have to be aware that you are liable for a new Medicare tax of 0.9%.
Now that's in addition to what people were paying before.
Yes, and I'll get to a little bit on that. The new Medicare tax of 0.9% and the tax on net investment income, which is 3.8%. And the reason I say that's yes, it is in addition, and you have to be careful about this. Do a little tax planning. I'll give the example of a married couple. Their magic number is $250. So let's suppose that one member of the couple makes $300,000. Let's suppose that one member of the couple makes $240,000. Employers are required to withhold the tax once income goes over $200,000. Okay, so the individual that makes $240,000 has had Medicare tax withheld on $40,000. But if it's a one-earner household, the income is under $250,000, and they don't owe the tax on that $40,000 that's been withheld. Okay. So they'll get that back when they do their tax return.
Now they have to. What
that
do they
works
have
out
to
well
do to get that back?
File a tax return.
And they have to note that.
Well, it's going to be on the W-2.
Okay.
Okay, and then when you do your tax return, there's a new form that you report this tax on, get a credit for. It shows up just like you've paid an extra withholding because you have been over withheld because the employer is supposed to take this out. So this is in addition to the Medicare tax, and this withholding in this case, I hesitate to say works to the taxpayer's benefit, but does not harm the taxpayer.
Okay.
Because the taxpayer gets it back at the end. Now we have another married couple, and he makes $180 and she makes
80.
Okay, now we're over $260. Now we're over $250.
Right.
And neither one of them has had any tax withheld.
Ah.
Because their income separately was under $200. So that couple is over the $250 limit, but hasn't had any tax taken out on that. And in their case, it's only $10,000, that the tax is owed on. There are a couple little things for a married couple that you have to watch out.
Now, with forms with that or online, how do you do that? Is that wouldn't only be for people who deduct, who itemize?
Oh, that's correct, yes. There's a new form in the 8000 series, and I'll confess I don't know the number.
So if you make over 200, you definitely, or if combined you make over 250, you need to know to get this form.
Correct, yes. And in the beginnings of most of the IRS publications where it talks about what's new this year, they mention that quite prominently. There's a new form to report this and pay this. But that's just a little wrinkle that, and obviously it only applies to people who have that income. But if you are at that income level,
pay attention.
You need to be aware of it.
Right.
That's all. So that's the new thing for people in that range. The 400 and 450, there is a new maximum tax rate. I say a new maximum tax rate. The old maximum tax rate of 39.6% is back for people whose income is over 400.
That had to do with the George Bush tax cuts?
Yes.
Okay.
Yes, that was pre-2001, there was a 39.6% rate.
Went away.
It went away, and now it's back.
Okay.
All right, and that's like many things in taxes. These things they come, they go, they come back again. So those individuals are now looking at an additional marginal tax rate. Some people whose income is even above that level won't be affected as much by alternative minimum tax because they'll be paying more under the regular tax system. So that's just another awareness thing. If your income was at that level and you didn't make adjustments to your withholding in 2013, you may want to look at making adjustments in 2014. So that's the big thing really for, and again, it's mostly for higher income taxpayers, but it's an awareness item for everybody. When I talk about making withholding adjustments, one that comes up all the time is in terms of the child tax credit. And this is a credit that came, got increased, was rumored to be leaving, and it was made permanent. Okay?
Oh, it's permanent, so they don't have to vote on it anymore?
The existence of the credit is permanent.
They could always take it away, of course.
Well, yes, I guess they could. They could take it away. There's one
But it doesn't
portion.
depend on a vote every year.
No, it does not depend on a vote every year.
Okay.
It's important. Now, this credit is good for children who are under the age of 17. And then the credit goes away. So when children get really expensive, credit disappears.
Gone. That's not fair. What's about this 26 with the health thing? You should
well,
go up to that.
Yeah. So if you have a federal refund that is in part based on this credit, and your child is 17, and you want to maintain that refund, you need to make a change to your withholding. So if your refund this year is $200 and you have a $1,000 child tax credit, which you won't be eligible for next year, if you don't change your withholding, you're going to owe $800 a year from now. So that's an awareness item that I think about. That people love credits. Credits are wonderful. They reduce
They're the best.
They're the best. They reduce your tax.
Right.
Okay. But when they go away, you have to make modifications to
Right.
adjust for that. Now, some people, although I said it goes away, for some people it comes back because there is still an American Opportunity Credit for education. So you lose the child tax credit for a year or two while you're getting your child licensed and applying for college, and that expense is happening. Then they go to college, and the other credit kicks in. And for that credit, the American Opportunity Credit, it's up to $2,500. It's partially refundable. You can take it for 4 years.
And that's pretty significant,
yes.
Especially for a state school.
Yes, yes. I mean, it pays $2,500, I think, pays most of a semester's tuition.
Right.
So yes, that is a significant, and it's for tuition, not
Right.
room and board.
Okay.
Make sure you keep track of how many years you've done this, because IRS keeps track.
Right.
4 years is it, okay?
Right.
Okay.
So get that kid through school.
Well, if you need more than 4 years of the credit, you can also use there's another part of the credit, of the entire education credit, called the Lifetime Learning Credit. And that is not as generous as the American Opportunity Credit. But if you've used your maximum American Opportunity Credit, then you can do the Lifetime Learning.
Okay. And that would include graduate study then?
Graduate study is included on Lifetime Learning, but
Okay.
not on American Opportunity. And along that same line, if you're getting the American Opportunity Credit for 4 years, and you have a year where perhaps your child or you took a minimal number of courses, small credit, don't waste your credit on a year when you're not going to max it out, if you are going to have 4 years when you will get the maximum credit.
Good idea.
Do you see what I mean?
Yes, absolutely.
You know, most of the time that's not an issue, but sometimes children take
Well, they could take a semester off,
or they could take college-level classes in high school. We would not typically you wouldn't use the American Opportunity Credit for those classes, because if they're going to college, then you've given that up for the year. It's
Right.
not how much money, it's how many times.
Right.
So that's credits. People love credits. We talked a little bit about things coming and going, and nothing is more indicative of the coming and going than the energy credits.
I was looking forward to that.
Okay. They come, they go. I think we had them in the 80s. They went away, they came back throughout the past. We have them 1 year, they're gone. It was supposed to be gone this year, and it came back.
That's
and
good.
It's gone again next year. And
Unless it comes back?
Unless it comes back. And when I'm talking about energy credits now, I am talking about thermal windows, doors, insulation.
Okay, a new refrigerator. That's more, no.
No.
Okay, I'll be quiet.
All right. Not refrigerators. Commercial firms can do appliances,
Okay.
but the average homeowner, no. I'm talking about that kind of energy, weather stripping, caulking,
Okay.
all that stuff. There's a $500 lifetime limit, and if you've done this in the past, in this recent round, as I say, we had something, I think, in the 80s, you've got to keep track of how much you've taken, because if you don't, IRS does, and they send you a letter saying, you know, we see you've already used your $500 maximum, so you're not entitled to another $200.
Okay.
Now, there are some other more generous energy credits for like
Solar?
photovoltaic, all that stuff. And I believe those run through 2015 or 2016. And 2015 is right around the corner.
It is,
I mean, it sounded so far away when
And is that through that 2015 tax year?
Yes.
Okay.
Yes. Yeah. And it may be 2016. I wouldn't swear to that. But if you've been thinking about, you know, if you're seeing your neighbor with solar panels and thinking,
And they
"Oh,
talk
maybe
to you
this
and
is
they say, I got this,
And it's wonderful.
It's going to pay itself back, and I'm
Right.
so happy, and you feel like, why didn't I do that?
Right, you can still do that. Okay, but those are more large-scale projects, not. And
Okay.
I don't mean to say that a new efficient furnace isn't large scale. I mean, that could
Well, that
be
can
thousands
be.
of dollars.
But weather stripping is,
yeah, weather stripping is
and 500 still the limit.
is still the limit.
Right.
Yeah. So that's one of those credits. You know, stay tuned. It could go away and come back again.
Right. Now, is there something about autos? Is that still good if you buy a
If you
hybrid
buy
or electric?
certain types of autos, yes.
And is that part of the solar, or is that a different
No,
credit?
that's a different, there's a different credit if it's I think right now the credit is, and you have to be an early adopter in most cases for the autos. At least this is how they did it with the hybrid vehicles. After the auto manufacturer had sold a certain number of models, the credit went away.
Now, is that per year, or is that because
well,
we've had Priuses around for a long
Right.
time
Well,
now?
I believe Priuses are no longer qualified.
Oh.
Like once the manufacturer sells a certain number of models,
I see.
it stopped now, and it
So
doesn't
the
stop
Volt,
mid-year.
the Volt, which is all electric, the Chevrolet.
That's a plug-in, and that's a
Okay.
different credit.
Okay.
Okay. So, and if you are, and this is something for people who are contemplating purchases, many of these items, if you're buying one of these cars, the dealers know which cars qualify for credits.
I was just going to say, it's getting
Yes.
too complicated
Yeah.
because now the Prius has a plug-in.
Right.
And maybe that one is...
Right. And that is really, and the same thing with energy efficient, not that we can do this for 2014, but to meet the energy efficiency standards, I usually say to my client, you need to go to the manufacturer, where you're buying this from, and they will be able to tell you whether it meets the energy efficiency
Okay.
standards. You know, it's not something I do as a tax professional.
Right.
Because
You're not an engineer.
I'm not, that's right. So those are the principal new items, I would say.
When we were talking, you mentioned something about a home office. Is that a deduction now? We're getting into another area?
We're getting into another area. This is new this year. I forgot about that. Home offices, some people think of as the biggest red flag in the industry. I disagree. I think if you are legitimately using an office and can document it, it's not a red flag, and indeed you should take the deduction as long as you understand what the rules are. And there are some, and you have to be cognizant of them.
Now, in terms of the red flag, just to check this, let's say, is the first year you do this more likely to be red flag than if you've been doing it, or do they not keep track that way?
I don't know. IRS doesn't
don't
tell
tell
us
you, of course.
what might create an audit, but just looking at returns in the past that have been audited, I think there are other characteristics on the return that would identify this return for audit. And then once that return is identified, if it turns out that there's an office and home there, see, when you have an office and home, one thing it does, if you're a small business owner, self-employed, an office and home, all your mileage becomes deductible when you walk out of the door for business purposes.
I don't get it, but they get it.
Yes, okay.
And they're working at home. It seems unfair.
It does. But often the mileage deduction is worth more than the home office deduction. But the home office deduction is what gives you the means to say, well, I'm leaving my office and I'm going to the post office.
So
to pick up
don't
my mail.
just look at the office expense. Look
Right.
also at the driving expense.
Right.
Interesting.
And there was they changed and made much more draconian the rules about deducting an office and home probably 10 years ago now. And it all resulted because a surgeon, I believe he was a surgeon somewhere, had an office and home and set up an office and took his mileage back and forth from his office to where he operated. And he had excessive mileage expenses. IRS audited and said, you don't really have a home office and you have to be doing your profession at the office in order to claim a deduction. Well, obviously he wasn't performing surgery at home.
We would hope not.
Okay, and then they took that away, and now you don't have to meet with clients. You can use it for record keeping. It has to be a dedicated space for the office. But one thing that has been the bane of preparation for office and home is that you need the square footage of the room you're using. It has to be dedicated. You need your mortgage interest, your taxes, your utilities, because
Do you take a percentage?
you take a percentage
Okay.
based on the square footage. The percentage is the area of the office is the numerator, the size of the house is the denominator, and that percentage is what you use to apply to all these other expenses you have on your home. So this entails some extra record keeping for people.
Right.
Okay. Simplified office and home this year. you can take up to a 300 square foot office at $5 a square foot, up to $1,500, and you don't have to do all that
And that's
other
a
record
fairly
keeping.
big room.
Yes, and you still get to take your full mortgage and taxes and all that stuff. So that, we're really excited about this because
Right.
it's going to simplify things for a lot of people. You know, sometimes we'll have a client with office and home, and they'll be like, I forgot my property tax bill, or I forgot my homeowner's insurance statement. It holds things up. So now,
I
you
see.
do not have to use this rule. If you have a larger office and home expense, you can still use the traditional method, but this is going to make it a lot easier for a lot of people, I
Great.
think. Yeah, no, it is. It's just, you know, I worked with a couple clients already on it, and they qualify, they're getting more, and it's much easier, and that's all good. So,
Medical expenses.
medical expenses.
I've always looked at them and I said, well, I can't possibly use this.
Right, and that's true for most people. Now, the office and home happens when you are self-employed, or if you are an employee and you have an office at home for the convenience of your employer. And that's not a lot of people, but it is some.
So that both are fine.
Both are fine. Medical expenses are part of what we call itemized deductions. You can only deduct them if you can itemize. And for most people, itemization really requires that you own a home and have a mortgage, because the standard deduction is $6,900 this year, $6,900 for a single person. So people will come in saying, well, I had all these expenses for medical, and the only itemized deduction they have might be their New York State tax withheld if they don't own a home.
Right.
And if that's a couple $1,000s, it's hard to come up with enough expenses just to get to that floor for the deduction amount. And on top of that, medical expenses this year for people who are over 65 remain at a floor, a threshold of 7.5% of income. And if you're younger than 65, the floor has been changed to 10%, which means you look at the bottom number on your tax return and you say, what is 10% of that number? And if your medical expenses exceed 10% of that number, you can take a medical expense deduction, but only if you can itemize. And you only get the excess.
So
it's very...
it really takes a lot off.
It takes a lot off. You might find yourself in a situation where you have no health insurance, or you have a lot of medical expenses.
Yeah, it's almost a catastrophic kind of thing.
Yes.
Serious things, a lot of drug needs or something.
Right, or you're paying long-term care insurance counts in this category.
Oh.
There are many seniors who have Medicare, long-term care insurance, a Medicare supplement, a prescription drug plan, and multiple visits to doctors and hospitals. Some of them are still able to deduct medical,
Now,
even though many of them don't have a mortgage.
Now that sounds like a really big thing, because
Right.
If you go into a nursing home, they're very expensive.
Right.
And so you're using up your income, and you don't want to bother your spouse's income, so you're very nervous about that. So any way you can prolong your own income, if that's what's going on,
Right.
is certainly helpful.
Yes, yeah. So there are seniors who take it, but medical, many times people will say to me, I had a lot of medical expenses this year, and I usually say, well, wait till we see what your income is, and then I'll talk to you about your medical. And because I don't want my clients to think that they're getting a deduction for something that I'm not
And then
really
they're
deducting.
disappointed, right?
You know?
Not good business,
Yeah,
right?
and I'll say, gosh, based on your income, which this year was $80,000, if you don't have at least $8,000 in medical expenses, it's not worth your time going back through all your records. And typically people say, oh, I thought I had a lot, but I don't have anywhere near that.
Right.
Yeah, you know.
It certainly feels like a lot.
Yes, yeah, when you're paying it, or, if you don't have a dental plan and you just, had a couple crowns done,
Right.
and that's a couple $1,000,
Right.
well, was it $8,000? And dental can be $8,000, but
But normally it's not. No.
So I don't, if you think you have a lot of medical expenses, I would encourage people to take a look at what the income level is first before they bother
Even
even trying.
right.
You know,
So
even,
once you see that threshold,
then you know.
and you say, well, there's just I don't need to add these numbers.
That's right. Right.
Right.
So medical, that's a little bit different, but again, not many people claim medical expenses, so it's not different for a lot of people. And they did keep the threshold at 7.5% for people over 65 because that can be a significant expense for them.
Right.
Especially, I would say, widows and widowers who have a smaller standard deduction than somebody who's filing jointly.
Right.
You know, so. Trying to think if there's anything else in the medical sphere. I don't think so. You mentioned something when we were talking earlier about job hunting expenses.
Right.
Okay. These fall into a similar umbrella like medical expenses. Often people will say, oh, I've got all this mileage for my employer, and I'll say, well, let me see what your income is. In that case, you're responsible for paying the first 2% of employee business expenses, and you get to deduct the excess, but only if you itemize.
Okay.
So in this same example, income $80,000.
2% is not.
$80,000 is $1,600. So if you're driving for your employer and the mileage rate was 56.5 cents per mile last year, in order to just get to the 1,600, you need to have driven probably 3,000 or 4,000 miles, just to get
Right.
to that point.
Right. So if you're
You know.
delivering papers, that's probably not an issue. But
Right. But if you're just
going to work.
Well, not even going to
Oh,
work.
yeah, well, you would easily.
If you're going from job site to job site, or if
Okay.
you're taking
Oh,
a
I see.
deposit to the bank,
Right.
or if you are a sales rep. Sales reps often will have this. They
drive all over.
They drive all over. You know, I had a sales rep one time whose territory was the Adirondacks, and he probably put 30 or 40,000 miles on his car every year. And I would say 85, 90% of that was business. So, you know,
That
but
works.
most people just don't drive that much for their employer, and then they've got to pay the first 2% on their own, and then they've got to have enough other expenses in the itemizing bucket for those to do them any good.
To get them over the
Right.
threshold.
Sometimes people talk about
Now, did you mention job hunting?
job hunting. I was
Right.
just going to say that's in that same category, employee business expenses, and the costs of finding a new job are deductible, but only if it's in your current line of work.
But until you found a job, how do they know?
Well, the
What-
first job doesn't count.
Right, but let's say you've been in sales,
Right.
or whatever you were in,
Right.
and you lose your job. Maybe the company
Right.
moves or whatever happens, and now you look for a job. Well, you're
Okay.
looking for a job, but how do they know what job you're looking for?
It's up to you to tell. Well, for instance, and I don't know whether this is something, you know how you put your occupation on the tax return?
Right.
I would say somebody in sales is likely going to end up in sales. Okay? Now,
Right.
you don't, if you've been selling widgets and now you move into selling tractors, you're still in sales.
Oh, you know what? See, I'm looking at it as, let's say,
You're unemployed.
You're
you
6
lost
months
your job.
unemployed,
Right.
and you start looking in July.
Right.
Well, you haven't found a job, and so all of these expenses are not going to
not
be
deductible.
They're not deductible until you find a job.
And only if it's in your field.
Oh, so the
Yes.
people who are really long-term unemployed, who are working hard, are getting nothing.
It's terrible, yes. Now, but once again, remember, they've got to be able to itemize, and those expenses have to exceed 2% of their adjusted gross income.
So that's
yes,
hard to meet also.
It's hard to meet. I mean, there are these two levels that you've got to get to. And yeah, you're right. I mean, people have been out of work for a long time. There, unfortunately, is, if they're looking for work in the same field, and they get a job, that's the other thing, you know.
Okay.
You can't switch careers and take those expenses, which is,
And you shouldn't
I
be thinking about that.
No, you should, no, and that's another thing. You shouldn't be thinking about that. There are times when it's important to think about taxes with a transaction that you're doing, but I don't ever encourage people to let that be the primary thing or the real motivating factor.
In their life, right.
Well, in other words, it often comes up with the sale of stock or stock gains and losses and so forth. And I always say, this could be a good thing for you to do, but the principal thing you should be thinking about is this a good transaction for me to sell this stock to buy another one? I mean, and what's your purpose in buying stock? Are you trying to make money?
Right.
Or do you just want stocks to write off for losses? I mean,
right.
is, now if you have gains and losses, it may make sense to offset some of your gains with loss,
Right.
But really, when it comes to investing, you need to think about the transaction in terms of why you bought the investment in the first place. Has it performed the way you wanted? Have you gotten the return that you want from it? And then make the decision.
And don't give up a good thing, because if you sell it, you might do better.
Yeah, right, exactly. I mean, it's, like sometimes people get too much into, is this a good thing for me to do tax-wise? And this sometimes happens too with small business owners. This is a common call at the end of the year. Gee, I've got money in my bank account. Should I buy something like a computer, or should I buy some new equipment? Because, if I buy it, then I don't have to pay tax on the money. And my answer to them is always, is this going to help you make more money? Because
Right.
you're in business to make money.
Right.
If you spend $10,000, you have avoided the tax on $10,000. True.
Right.
And let's say that your tax would be $3,000, state and federal combined.
Right.
Okay, so you've saved $3,000 in tax, but the $10,000 is gone.
It's gone, right.
And you have a piece of equipment that may or may not help you in your business.
Right.
I mean, if you need it, I mean, certainly. If it's going to help you make more money, certainly.
Then it's a good investment.
Then it's a good investment, yeah.
We've already used quite a bit of time, but I don't want
yes.
to not cover a couple other things. A couple of things have happened that are new that
Okay.
maybe they don't affect 2013, but the marriage laws that have been passed.
Yes. That's a good one, Richard, because that's important.
I'll just leave you go into that.
Okay. The Supreme Court decision last year that overturned the Defense of Marriage Act now makes same-sex marriage legal in the United States. And traditionally, marriage has been the province of the states. A state determines what the rules are for whether you can be married or not, how you get divorced. That's a state bailiwick. So if you are a New York State resident, same-sex couple, and you are married, in 2013, you must file as a married couple. Yes. Now, you can file married filing jointly. You can file married filing separately, but you can no longer use single filing status or head of household. If you had children, you could have used head of household status. You have the option, as long as you were married, I believe before the date of the Supreme Court decision, you have the option of filing amended returns for prior years when you were legally married in your state of residence, or you may not.
No, I mean, wouldn't you recommend they do not? Because I generally see a marriage penalty still exists.
Well, it depends on the income disparity between the partners.
Okay.
I personally have a same-sex couple. One member of the couple is the working member of the couple. The other one is the stay-at-home mom. And the working member of the couple earns in excess of $200,000. And as soon as DOMA was overturned, it was possible to file amended returns for 2011 and 2012.
Okay.
The combined refund for this household was over $12,000 for those 2 years. So absolutely, yes, absolutely. So it depends. Now, if this had been a couple where both worked and earned similar amounts of money, that would not be the case.
I see.
Okay, but for this couple, filing a joint return paid for the wedding.
So you really want to look at those back
You
years
have to look
and
at
analyze.
those. Yes, absolutely.
And it may be very worthwhile.
Yes, yeah. I mean, it really depends. And even if if it's not, the financial industry says past performance is no guarantee of future results. I'm saying this is not going to apply to every same-sex couple. I mean, this was really an extraordinary circumstance that there'd be this, this great difference in opportunity.
Oh, in that case.
Yeah, yeah. But you do need to look at it, evaluate it, and see whether it's in your interest. And if being required to file as a married person instead of a single person leaves you, because in my office, one of the other preparers has a couple where it's not advantageous for them to file jointly. If that happens, somebody needs to make some changes to withholding. That's another one of those kind of life changes. Yes, unless you want to. And it depends how much you have to pay. I mean, there's nothing wrong.
There's a penalty, right, if you get too far off?
If you get too far off, over $2,000 federal, over $3,000 state. No, but I mean, it's amazing. It's not a lot how many people just don't want to pay at the end of the year. So if you're in that position, and now that you're filing separately or jointly, you have a tax liability that you did not anticipate, you may need to make some adjustments to your
Actually, I
withholding.
misspoke. 2,000 would be a lot for a lot of people who just didn't know that they had to pay that.
Oh, yes.
Suddenly they have to pay 2,000.
Right, right.
I mean, you don't even want to.
Well, but the way I understood your comment was a penalty kicks in at $300 on the state, $2,000 on the federal.
That's what I meant.
That's not a lot of.
That's what I meant.
Yes, it would not be hard to get to that number.
No.
I mean, it can be a lot of money, but you really.
You do have to be careful.
You have
That's
to be careful.
The point.
Yes.
Right.
Yeah. No, I think I understood what you were trying to say there, because
The one other point, and I don't know where we go with it or even how valid it is, but it's probably worth asking just to find out that it's not. So the ACA, the Affordable Care Act, is going to affect mostly young people probably in terms of penalty, because they're the most likely evaluating, well, if I get a slap on the wrist, or should I just continue being immortal?
And they are immortal, aren't they? Okay. The Affordable Care Act basically gives you two choices. You can enroll for health insurance, or you can pay a penalty on your tax return. And the Affordable Care Act does do one thing for young people who are immortal, of course. It covers them till age 26. They can stay covered on their parents' plan until age 26.
Whether they're at home or not.
Right. That's a benefit I would have liked to have when my son graduated from college and did not have health insurance.
Yeah, that's wonderful.
So that's a good thing. We don't know yet how this is going to work. And the other thing, we're talking here about penalty, there are also credits that are available. So, and the credits are based on the amount of your income. You have to, I shouldn't say you have to buy. You have the option of enrolling for health insurance or face a penalty.
Right.
But the act of enrolling in health insurance with a tax return, you may be eligible for advanced tax credits that reduce the cost of your insurance. You may be eligible for insurance without having to pay a premium and without having to pay a penalty. So you need the...
That's extreme.
Yes. I mean, there are, depends on what your income is, and I believe it's based on the poverty level. So the result when you enroll for insurance is you have insurance. You may get a tax credit. You may have to pay for it, depending on the amount of your income.
Right.
If you don't enroll for insurance, you may face a penalty. So you really need, and I know the core of young people that they would really like to get registered, you really need to look into this to see how it affects you. And
not just think about, well, I'm probably not going to have a serious disease, but you could have a car accident. Or a skiing accident.
You could have a car accident or a ski accident. Typically, the car accident would be covered under your automobile policy. Okay, but a skiing accident. And there are other things that I think maybe you don't think about when you're young. Health insurance is changing everywhere. Things happen to you even when you are young that require expensive drug treatment or expensive medication. You need to think about this, even though you would not look at some young, healthy-looking people. They may have a disease or a condition that requires regular treatments that cost thousands of dollars,
Right.
or they may have a skin condition that requires drugs that without the copay, it's, with the copay, it's $500 to buy this drug.
And we all know people who are in that situation.
That's right, yeah. And so, that's something, and, we're kind of learning as we go with this. And we do try, this is an awareness item for us. We're trying to point out to people that the penalties go up every year. They start in 2014 and they become, larger in 2015 and 2016. And I spoke with one young man and I said, you really need to check into this because I think you can have health insurance and it's not going to cost you anything.
Well, that would be a no-brainer.
Yes, so, and that's where, again, it's an awareness thing. And will they sign up if they think they're liable for a penalty? Some people are very happy to stay on their parents' policy.
Well, there's nothing wrong with that.
There's nothing wrong with
then
that.
they're covered.
Right, yeah.
One more area, because then we're really running out of time. But I think it's a interesting, and it might be helpful to somebody. We've recently had a case here, and this could happen to anybody in a lot of different levels, but the McGinn-Smith case,
sure.
A lot of local people lost a lot of money. How would you advise them in terms of tax deductibility?
Deductions. Excuse me. First of all, they probably should talk to a tax advisor about it, all right? And they're going to need good records to document what they invested, spent, whatever. There are there are three examples. It could be a theft, it could be a capital loss, or it could be some kind of a business loss or business bad debt. With any type of capital loss, you are limited to a deduction of $3,000 per year in excess of your capital gains. So if you have a $100,000 loss and this loss is a capital loss, you've got 30 years
to use
this, okay? Which may be okay if you're 20, but if you're 80, it's maybe not so wonderful.
Right, so
okay?
you're not going to get much back.
I have seen cases, or one case I'm thinking of, where it met all the requirements to be treated as a theft loss. It was considered a theft of money as opposed to a capital loss, and it really depends on how the money is invested. When you have a theft loss, you also have to itemize, but if we're talking a significant dollar amount, this alone would enable you to itemize. And for a given year, you would probably end up with a net operating loss on your tax return, and you have this almost certainly if you get to the bottom line and there's a negative number on page 1.
Okay,
that's a pretty good indication. You have to do some more work to actually figure out the math and how much and so forth. Once you have a net operating loss, you are allowed to carry your loss back in full for 2 years and then carry it forward for 20, and it's an offset to income. So it is much more generous than being able to deduct $3,000 a year, but you have to make sure you qualify.
So I think with all of that said, we're not recommending any specific action except that they definitely should talk to somebody,
right,
because it may be very helpful.
Yes, absolutely. Because that's not something if I were in that position, I would certainly want professional advice and somebody backing me up, being willing to explain it. Should I be asked why? And then just, I'm just thinking about the Bernie Madoff case. There are other side things to that.
Right.
There are implications if you have more or less income for whether it makes you pay a higher Medicare tax and so forth and so on. There's sort of this trickle-down effect with taxes.
So it gets very complicated in those cases.
Yeah. And I would say that's, talk to somebody about it and have good records. That's essential for something like that.
I want to thank you, Patricia. This has been really interesting.
It has, and I know we've gone over, and I thank you for giving me all that extra time.
Well, we'll see how many people have the patience to watch the whole program, but there was a lot of good information.
Well, thank you
so much.
It's a pleasure being here. Okay.
And I want to thank you for watching. I hope you enjoyed the show, that you get some tips out of it, and that you have a great week. Take care. Welcome to Colonie TV, the governmental educational channel for the town of Colonie.